really strong rally, relief rally, narrow rally in US equities last week. This week?
I think this week that the risk reward is turning a little bit less favourable. So we talked all the last week about the idea that it was going to remain choppy conditions, but it would ultimately be likely be a relief rally because the marginal news flow will be positive. I think that's changing from here. I'm not saying it's outright negative yet, but I think that the potential positive catalysts are beginning to be balanced by the fact that we're getting more nervous about the likely supply shock coming to the US in about 2 or 3 weeks' time. And I think people are increasingly focused on that. We could get an update tomorrow showing that shipping rates from China to US continue to drop. They've already slumped massively over the last couple of weeks. And if that continues to drop from there, we'll see that impact around the middle of May. And I think people will focus on that. So from here, I still think it's choppy markets, but I no longer think choppy markets are the relief rally. I think it's choppy markets in a neutral overall tone. But the next big move is going to be to the downside. And we're looking for that catalyst now, which means it's less favourable for short-term traders to try to trade that relief rally.
Mark, how much does this week's economic data out of the US actually matter when you've got the likes of Apollo's Torsten Slok pointing to these high-frequency indicators because the situation is moving so much? Is it that time, like in COVID, when we need to start looking into these little detailed data sets rather than the big numbers like we're getting this week?
Yes, Lizzie, but I'd say that's always the case to some extent. I mean, GDP prints are always useless to trade off. They make good headlines and newspaper writers like having them, but ultimately traders tend to ignore GDP. By the time we're getting GDP, it's well in the past. I mean, you take this week's Wednesday release of first quarter GDP from the US. This is the advanced reading, but it comes from before the Liberation Day announcement of reciprocal tariffs. It comes from, a period that was ended a month ago. And all it's saying is, hey, the US economy was already slowing going into kind of the decimation wreaked by the US administration's latest round of kind of policy announcements. So it's not really overly tradable, but it will increase focus on the fact that US growth is problematic and US growth forecasts are getting downgraded rapidly, and Sell America will remain a strong theme this year.
What about payrolls? What about ISM manufacturing Friday? Kind of talk us through those pieces of data. It feels like payrolls is taking on a higher and higher level of importance as the Fed waits and watches to see whether or not there are cracks appearing in the labour market.
I'm not sure this payrolls yet matters quite so much. I think you're right, Guy, to draw attention to the fact that Fed policy, what will change Fed policy and see them come to the rescue will be the labour market cracking. But I think we're probably too early to see major signs there. Initial claims aren't showing kind of sustained weakness yet. I think the ISM print does matter more, but ultimately everything is about trade and tariffs. And I think that it's not just the headlines we get on that, and we flagged last week that they're going to be marginally positive, but the real damage that we're seeing from what's happened already, the effective trade embargo between China and US and that supply shock that's coming for the US, that's the bad news that's coming.